Let's finish chapter 20 by bringing it all together and sort of finding the relationship between creditors turnover and the cash cycle. So what we've been looking at is we said the cash cycle measures how long it takes to purchase stock from suppliers, then sell it to customers, and we measured that with our stock turnover ratio. And then we looked at how long does it take to collect the cash owing from debtors, which we measure with our debtors turnover ratio. And the problem with that is it's not actually a full picture of how a business works. So what we're actually forgetting is that once we buy stock, before we sell it, we need to remember there's actually something else that needs to happen. We need to pay back the creditors for that stock. So it's not really something I've got it as step 4 there, but it's something that needs to happen as soon as possible. If it's step 2, all the better. It can be step 4, but it all depends on how big the cash cycle is. So what we want to say is let's look at a creditor's turnover of 58 days, for example. If we take the average time to sell stock is 24 days, so that's a stock turnover of 24, and then collect cash from debtors is 27 days, that's a total of 51, and we are paying our creditors back in 58 days. So up here, it's taking us 58, and we'll have that cash well in time because it's only taking us together 51 days before we've got the money and we get back to this point here and we can pay back our creditors. So looking at that, what just happened, we said when we buy stock, it takes us on average 58 days to pay creditors back. And looking at that was measured by a creditors turnover ratio, and then compare that to how long it takes us to sell stock. So the first step was we sold it to customers, which was our stock turnover ratio of 24 days. And then it took us another 27 days on average to collect the amounts owing from debtors. So that's a good result. We've got a cash cycle of 51 days and a creditors turnover of 58 days. And what that leaves us with is 7 days extra to have the cash to pay creditors. We've actually got the money from selling that stock before we have to pay creditors for it. So that's a good result. Looking at a different example, we purchase stock on credit from suppliers. Let's say on average it takes us 45 days to pay our creditors back. One thing we want to factor in, if that's a good or bad result, is how long does it take to sell stock to customers. So for example, the stock turnover here is 26 days. And then how long does it take to collect those amounts owing from debtors? So in this case it's 32 days. So in this case the cash cycle is actually going to be longer than the time it takes to pay money to debtors. So we've got a total cash cycle of 58 days, but the problem is we're actually paying creditors back on average in 45 days. So looking at that, buying stock on day 0, on average we were paying for that on day 45, and the problem is we don't have the money from that stock to pay for it by day 45. We're going to need to find the money from somewhere else. And the reason that is because whilst our creditors turnover is 45 days, the time it takes to sell stock on average is 26 days, and then the time it takes to get that money from debtors is 32 days. We won't have the money for another 13 days after we pay our creditors back on average. So the problem there is for 13 days we need to pay creditors back and we don't have the money from the stock that we owe them for. So we're going to have to find the money from somewhere else. We might need to borrow it, we might need to make a capital contribution, we might need to sell a non-current asset, for example, and that's not a good result. We want to try and pay our creditors back after we've been able to sell the stock that we've actually bought from them.